Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. Before we jump into our next episode, we have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review. We encourage your feedback. It'll help us make these episodes a better listen for you. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse. As always, I'm your host, Todd Anderson, Head of Content and Programming at Deal Catalyst. Joining me today is Stuart Wall, CEO and co-founder at Setpoint. Stuart, it's great to meet you virtually. I really appreciate your time today. Thank you for coming on the show.
Thanks for having me, Todd.
So, I think when it comes to timeliness of these podcasts, I'm not sure if we always strike the right balance of when an episode should come out, but I think that is not the case here. I think it could not be more timely given the recent news about Tricolor and First Brands. And I know as the markets are still kind of processing some of the stuff going on with both companies and both situations, what do these failures kind of reveal about how fragile, some of the asset-based market is today?
Yeah, so to give a little bit of context, Tricolor was alleged to have double pledged assets to three different warehouse lines and has gone bankrupt. I think there's hundreds of millions of exposure. In the case of First Brands, there's been some alleged double pledging, also manipulation of loan tape. And I think what's caused a lot of concern in the industry is that not just the scale of these issues, but also a lot of the market accepted practices were in place. So there was a custodian, a backup servicer, a lot of the players that you typically see in deals like this exist, and the fraud still happens. So I think that's created a realization in the industry that some of the market accepted practices are not sufficient for today's environment. And obviously for these two companies, the tide washed out. So the issues became known, I think, to both the lenders and the broader public. We think there may be similar problems in other companies that maybe still for today are doing okay, but I think it is a good catalyst to drive a different approach for a lot of lenders and borrowers in ABF.
That kind of leads into my next question. Why does it matter so much for lenders, investors, regulators? Like, I'm sure some people in the market are thinking, hey, this is, we don't have exposure here. They're just two incidents, but it clearly is it's not just two incidents. It goes a bit deeper than that, right?
Yeah, I mean, I think the broader ABF market has grown a lot. It's hard to get an exact estimate, but some quote it at 7 billion. I think as part of that, you've seen a lot of growth in private credit funds, and you've seen more origination, aggregation, syndication happening. So there can be more kind of steps in the process for between the point of origination to that asset being included in securitization. And I think that the protections that exist today largely kind of came out of the GFC and just aren't sufficient for today's market, and really don't protect against issues. And if you really look at some of the issues that happen in these two cases, it's believable that something similar could happen in another scenario. And we think of it as, if you look at ABF, a lot of the risk, in our opinion, is between fingers and the keyboard. It's fraud and mistakes. I think it's more often mistakes than fraud. Obviously, fraud does exist and will continue to exist. But we think it's really important for lenders who want to, optimize risk-adjusted return to have processes in place that catch this. And I think if you take it a step further, it's not just having a great operational process so you don't kind of fall victim to a double pledge scenario or a falsified data tape. But it also, having great operations allows you to be more flexible as a lender. It allows you to, do deals that others might not do. You can scale quickly. You don't have to worry about, people going on PTO or leaving your firm, and then all of a sudden you're not sure how to support one of your borrowers. So we think, it's both a protective mechanism, but also an opportunity.
So before we go into a little bit more exactly what is double pledging, what happened in these cases, tell us a little bit more Who is Setpoint? Exactly what do you guys do? Give the audience a little background.
Yeah, so Setpoint is the operating system for asset-backed lending. We think there's been a lot of innovation on the front end of fintech. So if you go to Carvana and you want to get a car lease, it's a pretty good experience as a
Hmm.
consumer. And there's kind of similar examples across SMB and all these other categories. I think what's not well understood is what happens next. So, in a company like Carvana has different warehouse lines and securitizations. That process still, for the most part, runs on email, Excel, and FTP folders. We think that creates a lot of risk for lenders, and it's really efficient for both the borrower and the lender. So we exist to solve that. We have three, products that we offer. The first one we call Data OS, where the mandate is organizing and verifying data. That can be mapping loan tapes with different fields for a lender that's getting information from a lot of borrowers. The data tapes are not standardized. We also verify the data itself, which could be either programmatic or with verification agent, which would mean looking at a document and comparing it to the loan tape. But the output of Data OS is organized, verified asset data. The second product we call Capital OS, and that's all the calculations that are needed to do a waterfall calculation or compliance. Right now, that's in Excel. Excel has no version control. We often find mistakes in those files. I think moving it to software is a lot faster, a lot less error prone. The third product we call Insight OS. And so once you have all the data and calculations, you can create kind of dashboards, reporting, and even have a natural language interface just to understand what's happening in your portfolio in a way that's not possible with Excel. So that's really what Setpoint is here to do. And I think if we're to the extent we're successful, our goal is really building trust in our system of credit, which we think is very important. And I think this could be a catalyst for really a new approach to managing a lot of these ABF facilities.
So, can you tell maybe for those who might be, not as initiated, exactly what double pledging is, and ultimately how does the same asset, end up, being used twice with essentially not anyone noticing?
Yeah, so it the idea is that you originate, you know, assets. So in this case, loans. You might have multiple lenders, and you basically just pledge the same asset multiple times. So in this case, just using Tricolor as an example, again, this is alleged. We don't have any information that's not public, but there were three different warehouse lenders, and all three of them thought they had the same auto loan as collateral against their warehouse lines. So they more or less extended, more capital than there was the collateral to support. That can happen. I think there's more risk kind of in today's environment where it's not just a bank originating assets and funding them with
Hmm.
deposits and holding them on their balance sheet where they're pretty close to the point of origination. There's kind of more links in the chain, so there's more trust that has to happen. And we've seen examples or kind of been told about examples of double pledging. Most of the time are by mistake. Maybe someone sold some assets, they didn't update their loan tape, they included them in a funding request, which would result in them, drawing more capital than they were should have been able to do. That can create a big issue for the borrower, even if it's an honest mistake, and obviously creates risk for the lender. So those situations do exist, and there's been some, public examples of that in the past. There's also, fraud of, you want to have access to more capital than, you know, you actually are able to access. And so you just replicate the loan tape three times and send it to the lender. And a lot of the lenders today more or less trust the data that they receive from the borrower.
As a follow up to your previous answer, is part of the issue that it's done in private markets, unlike public markets where the information accessibility is equal. Is private credit where the information accessibility is unequal between different lenders? Is that part of this issue?
Yeah, I mean, I think it's a good question, but I think the answer actually in this case is no. And I think the problem
Okay.
is there's not a ledger that exists, really outside of real estate, where you have a system called MERS that keeps track of all the assets within a given asset class, whether you're in public markets or private markets, that one lender could use to verify that the assets that have been pledged to them have not been pledged to someone else. I think that exists in both public and private markets outside of real estate and some other examples. And I think that siloed information where every lender only knows what has been pledged to them and not what that same borrower has pledged to others creates some of this double pledging risk.
So, I know part of this has to do with there's a beautiful, really clean, great customer experience on the front end, but the back end is a mix of technology or spreadsheets or other systems that are kind of fragmented, trying to work together. Is that kind of where some of this core issue hits? Is that it's just the back end hasn't had the same, perfect uplift as the front end?
Yeah, I think that's right. I mean, I think a lot of the back end, I use the word esoteric a decent amount. I think for people that are in the industry, they understand, what it's like to get hundreds of Excel files if you're a bank from all of your warehouse lines and and,
Hmm.
and try to stare and compare to solve it. But it's not well understood outside of the industry. I think for a lot of the lenders, it's something that's important but not urgent. And so if you look at where they're investing, they might be investing in origination or kind of different areas of their business. I often find that the operations team, there's ideas on things they want to build for them, but they often aren't able to get the resources. And then I'd say the last thing is that there's a little bit of a mindset of if it's not broken, don't fix it. And some of these market accepted practices have been in place for a long time. Some of them changed during the great financial crisis, but to the extent there's not a catalyst, there can be pushback on adopting something new. So I do think we've seen a different environment after First Brands Tricolor, where there is more kind of willingness to do things differently. I'd also say, Setpoint was launched in 2021. We've been growing very quickly. We work with a lot of lenders, banks, and borrowers. So I think even before Tricolor, there was an understanding that, having great capital markets operations not just lowers risk, but can help you as a lender, generate better risk-adjusted returns, and as a borrower, just really get a handle on your business.
So I understand you guys have recently launched a new product. What is that product? And tell us a little bit more about exactly what it does.
Yeah, so we launched a new product called Setpoint Pledge Check. The idea is we wanted to give borrowers the ability to produce a certification for their lenders that those assets that have been pledged to that lender, they're unique, and lenders protections that I think a lot of people are looking for coming out of Tricolor First Brands to have an understanding of, you know, kind of the other side of the same problem. What Pledge Check does is we basically get three sources of information. So we'll get a funding request or a purchase request. We can kind of work in a lot of different financing structures, whether that's a forward flow agreement or warehouse line or securitization. We then will also get the master loan tape data that could either be from a system of record, something like Snowflake or an LOS or the system that the borrower's using. We also get bank statement data, so we can kind of understand the cash flows that are happening with that bank statement in the collections account. Between those three sources of data, we can do checks to make sure that all the assets are unique and there's identifiers, things like social security numbers, VIN numbers in the case of auto, asset ID numbers. We can do some checks to validate that no asset shows up twice, using the master loan tape as well as the funding requests. We also can look at the bank statement data to get an understanding if the collections in that bank account effectively match what would be expected from a similar pool of assets. And that prevents a situation where a borrower might fabricate assets that don't really exist, and that would show up in the collections data that what was being represented in the data tape is not consistent with reality. So between those three, it's a very lightweight product. It's not particularly expensive. The lender gets a certificate that the borrower has kind of passed the pledge check. I think the borrower gets to kind of reassure their lenders and hopefully continue to have access to capital, because they can reassure them against this concern that I think frankly is potentially slowing down the market and preventing deals from getting done.
So is this something that lenders have to opt into?
The lender doesn't necessarily, I mean, a lot of the lenders are requesting it, but they're not necessarily the customer. So the borrower would pay for the service. The lender would then get, the benefit of a certificate, but the lender doesn't necessarily have to opt in or directly pay Setpoint for the service.
And then how does it maintain borrower confidentiality while still verifying that uniqueness?
Yeah, so I think that's why it's important to have an independent third party. I think if you're a lender, it'd be difficult for you to say, I want to get all of your data for all the assets, including the ones you're not pledging to me, whether you're holding them on balance sheet or
Yeah.
you pledge them to another lender. I think, that could violate confidentiality for other lenders as well as the borrower. We operate as an independent third party. We'll look at the master loan tape. We'll look at that lender's assets. We don't report back any information about other lenders or anything else to the lender other than the pledge check itself for this specific product. And we obviously, as part of our business, we have access to a lot of confidential information, and we've gone through security processes with a lot of large banks and private credit funds. And so I think we have the protections in place that borrowers and lenders are needed for borrowers and lenders to feel comfortable.
Given how fast private credit has grown the last 5-10 years, does the industry risk losing investor confidence without better data standards across the market?
I think of it as more of an opportunity. If you're in private credit markets, you may have the perception is that public is safe and private is risky, and we think that's not true. I also think there are a lot of benefits of to private credit funds, just in terms of matching duration of assets and being more flexible than bank lenders can be. So we think what's happening with the growth of private credit is a very healthy thing for the ecosystem. I think that it's good for the investors in private credit funds, and I think there's a lot of demand to participate. I think it's great for borrowers as well. So the other thing I think that is interesting is private credit funds typically adopt things a little bit faster than banks. There's less regulation, and I think more willingness to try new things or add new systems. And so to the extent there's some adoption of new tools and software that allows them to better monitor data than potentially even the bank lenders can, which would reinforce their advantages of being more flexible, being able to move faster. I think that could really differentiate private credit funds, and you could more or less get paid for great operations. So I see it as an opportunity more than a risk. But I think certainly a lot of people are looking at it now, and maybe some of their investors are asking about it, given what happened with Tricolor and First Brands.
Do you think we can get to a place where double pledging is made impossible?
The short answer is probably not. I think there's always going to be fraud, and I think what you want to do as a lender is you want to make it as difficult as possible to commit fraud, which I think will catch most of it. But there's always, particularly for bad actors, a little bit of an arms race where you might be using AI tools to generate fake invoices. Like if you really want to be aggressive, you can try to take a lot of steps that would fool a system that's trying to catch fraud. But I think to the extent it's an arms race, if you're a lender, you do want to have something, right? You don't want to purely rely on borrower data in Excel. And so I think the more systems and processes you put in place, the more you can mitigate that. And frankly, the bad actors are more likely to avoid you as a lender if you have systems in place and you're not the easiest game in town to commit fraud.
If you could, send one message to lenders and borrowers, what would that message be?
Yeah, I think this kind of current environment we're in with First Brands and Tricolor, I think it's a good opportunity to be a catalyst to change the operating procedure. So I think we should move out of email, Excel, and FTP folders. I think people should move to a system to help them manage data, do calculations, produce reporting. And this is a good time to be proactive and lean into that. I think a lot of people might have the reaction, this is not directly affecting us or not directly affecting our asset classes. But there are cycles in credit markets, and typically these things become more obvious when you're in a down cycle. And so I think it's a good opportunity to lean into it. Don't wait for that to happen. And I think you'll mitigate your downside risk and also create the opportunity just to scale with fewer people and be more flexible.
As a follow-up to that, I've been in and around fintech for over a decade now. And I think obviously we talked about it a little bit earlier, how the customer experience has been solved, at least for those with good credit. Like, if you have good credit, like you can easily go online and it's very seamless and simple. Boom, you can get a loan. Obviously with small businesses and corporates, it tends to be trickier because the data from one company to the next can be different. But can an incident like this with First Brands and Tricolor um, does it, kind of end up being the moment that's needed to actually switch the back end to make it as efficient as the front end? It feels like we've been in and around digital lending for almost 20 years, and it still feels like it's like analog versus digital on the front end. It just still feels mismatched, and I'm surprised that to this day it still hasn't been fully solved.
Yeah, I mean, I certainly uh, think it could be a catalyst and people could lean into it. I mean, I think another thing that is relevant is a lot of the workflows actually are very bespoke and complex. And so if you look at these loan agreements, they're all unique, even two loan agreements to a, from the same lender to a borrowers, the same asset classes, have a lot of terms defined differently. And, I started my career at Bain. I spent a lot of time in Excel. Excel is an amazing tool and it does have the ability to be fully customized. And I think it has been a difficult software challenge because there's so much customization required in some of these workflows that these manual tools, frankly, may have been the best solution. I think in today's environment, 2025, the approach we take, there are some kind of AI tools that I think make the process of extracting, very complex bespoke information from a 250-page loan service agreement and codifying in software more tenable. The approach we take is you always have humans in the loop. This industry requires zero defect and auditability and an Excel output that someone can review. But I think the combination of some of the LLM tools plus, the approach we're taking is a human in the loop can convert, something that I think is very difficult to make software, which is these bespoke, complex agreements, more tenable. So I think there's a why now there that the technology is available today to do this well, and so now is the time to make the change.
What does a healthy, transparent, private credit ecosystem look like in, say, 5 years?
Yeah, I mean, I think in the way that Carta kind of created a new standard for mostly, venture-backed companies managing equity agreements. And
Hmm.
just to maybe finish that analog, it used to be that it used to be called e-shares, but everybody would have an Excel file, the investor, the company, the employee, and it was really difficult to collaborate. And you have this shared pool of ownership and everyone's collaborating over Excel. Carta came in. You want to have one system to manage all of your counterparties. So it had a natural viral coefficient where the investor wants to use Carta for everything. The company wants to use Carta for everything. So it kind of just overtook the market. And I think that really solved an important problem. I think a smaller scope than what we want to do. I think the same is true in ABF. We should move out of email, Excel, and FTP folders. There should be a new standard. That new standard, I think, does need to, organize, verify data, do the calculations in software, and provide either a data output or dashboards that people can use to know what's going on. I feel pretty strongly that that should exist. I certainly hope that Setpoint is the company that solves that problem. But if you get to that place, I think there are a lot of benefits for all the participants. I think, you know, all better manage risk. I think the assets themselves become more liquid. I think it becomes easier to collaborate. We see a lot of lenders, one might provide back leverage to a fund that, then there's a lot of like connected relationships that I
Hmm.
think could be better managed if there was one system as opposed to just a lot of manual Excel and email going back and forth.
So we have a few minutes left. I like to dig in a little bit differently as we get towards the latter half of the episode. So I believe you've been a founder. This is your second time now, unless there's something in your LinkedIn that's not there.
That's right.
What
Yeah.
is it about entrepreneurship that kind of appeals to you to kind of take the leap and become a founder?
Yeah, that's a good question. I mean, I think it's certainly true for me, and I think for a lot of people, it's just really fun to build something. And I think at the end of the day, every great company, really solves an important problem in a way that's way better than the way it was being solved before that company existed. So I sometimes think of a simple one like Uber and taxi cabs. I live in New York City. Taxis I
Yep.
still take taxis, but Uber was just way better. And there's a reason for that and everything else. But I think that like it's really fun to do something like that. And for the area that we're in, I kind of went through a process of like, what do I look for when I start a new company? And I like ideas that are esoteric. I think if it's well understood and easy to explain at a cocktail party, it's probably not a great business, is my general frame of reference. You want to have a huge TAM, so like a really big market opportunity. Those two are inversely correlated, so it's hard to find something that people don't understand that also has a lot of potential. And then the third, and this might be the most important, the existing solutions are really bad.
Yeah.
Because I think if you put those together and you make something that's like the Uber to the taxi cab, it's really fun because you're solving someone's problem and you can feel really good about the work and it's very tangible. And I also think you could build a big business. So yeah, I mean, I started a company called Signpost. I ran it for 9 years. It was a lot of fun. I took 6 months off, and I almost immediately want to do something new. So I'm really glad we're off to the races at Setpoint.
Biggest lesson as a founder?
Yeah, I think it really all comes down to the people. People say that a lot, but it's not just hiring well. It's also getting a team that works together well and is maximally collaborative and focused on impacting the business and customers, not politics. So yeah, I think I knew that conceptually, but I think I learned that in reality, mostly from making mistakes, just by having been an entrepreneur for a while.
What's your biggest regret as a founder?
Yeah, biggest regret would be periods in the journey where I'm not spending enough time talking to customers. I think as a founder, if you get too far from talking directly to customers to understand how they receive your product and what problems they have, you can lose your ability to really drive strategy and drive the culture of the company. So I try to spend as much time as I can with clients, both selling and talking to people that are already using the product or even prospects. But yeah, you can fall into periods where you're focused on other aspects of the business, and I think that can be dangerous.
Okay, a few fun rapid fire questions out the door. Favorite sports team and or hobby?
I'm going to go with the Indiana Pacers. I'm an Indianapolis native.
You must
And
really
hobby,
loved Halliburton's 3-pointer
I
at
loved
the
Halliburton
buzzer last year.
I know until it was a rough game, game 7, but yeah, it was fun.
Yes.
I live in New York. I went to some New York games, but I did not wear a Pacers jersey. I thought that might be dangerous. But
One surprising thing about yourself?
during COVID, I got into windsurfing, which I moved to Florida. I live in New York. Got into windsurfing. I really like it, but apparently it's off the beaten path. I'm by myself most of the time when I'm out there doing it.
Well, it feels like it's windy all the time now. So it might be a
It's a
good
good time
period.
it's a good time to pick it up. Exactly.
What would be one book you'd recommend reading?
I'm reading it now. I really enjoyed Aaron Ross Sorkin's 1929 about the Great Depression. Very good book.
Most exciting part of your job?
Yeah, I think the most important thing for a founder is building the machine, not necessarily doing all the work. So the most exciting thing for me is when the team produces something that's way better than I could have done on my own, and ideally I had nothing to do with it. And luckily at some point that happens a lot, and that's really exciting when you get to see it.
One prediction for the next 12 months?
I'll give you two: Colts in the Super Bowl as an Indiana fan. Let's see if they can keep it going. And the second one is I think that we're going to see some major private credit funds and banks adopt a new standard for ABF that I think will trickle down to the rest of the ecosystem.
Well, hopefully the cult part doesn't come true, given that I'm a Bills fan. But I think certainly the second point is one we all hope happens in the private credit sphere. So I think that's a good place to leave it. Stu, I greatly appreciate you coming on the show. So thank you for your time today. Continued success to you and the team.
Thanks, Todd.
Thanks for coming back to the latest episode of the Credit Clubhouse. We are your one-stop shop for all things credit. We have an exclusive offer for our listeners. If you're interested in attending any of our conferences throughout the year, we have a great deal for you. Just head to www.dealcatalyst.io, pick the event you want to attend, and enter the promo code CREDIT at checkout. This will give you 10% off any ticket to any conference. As always, don't forget to follow the show, rate us, and leave a review.